Greetings, class. This is the Chapter 9 video. I'm going to go over some of the material that we'll be covering this week in Chapter 9, covering risk management and the role of insurance, talking about some of the specific types of insurance that you need to think about and really addressing what those are and how they work. So, the first thing I want to talk about is what we're actually going to cover in the chapter. We're going to talk about the general health insurance and health management, general insurance and health management, and what insurance really is. We're going to talk about some of the costs and options and requirements with health insurance. Then we're going to skip over the disability insurance section and jump right to life insurance. And then for the last three components of the chapter, we're going to pass over those and really kind of uh, not really address the auto insurance, homeowners insurance, or long-term care insurance. So with that in mind, we'll start with the first section, which is what is insurance and why do you need it? Well, first of all, you want to protect the human capital that we've talked about from the beginning of this course. And human capital is your ability to work, learn, earn, and basically make good decisions about how to save money, use your money, or whatever. Uh, but again, that human capital it dictates what you're going to be able to do in life, how your health is, and so forth. And the human capital does impact what all the things are that you can do. Now, the biggest risk is that you would lose that human capital or the ability to work, or that you would have the ability to function like normal. And therefore, insurance is really a transfer of that risk from yourself to an insurance company who, for the price of a contract, will cover a certain amount of that human capital, uh, either in ongoing income or health care or something of that nature. So, what is it that determines your health? Now, I'm not really sure exactly how they came up with these percentages, but health behavior does have a large impact on your health. So, if you're active, you do a lot of other things, you engage in other activities, your health behavior here can impact your actual overall health and your outlook on your human capital in a much bigger way than any other factor. The second biggest thing is going to be genetic disposition right here. Now, those two combined are approximately 70% of this pie here that we're talking about. Now, there are going to be other factors like social circumstances and the environment and medical care, the availability of medical care. Those are all going to impact your health. And I'm not saying that they're not that important, but I am going to say that what you do in terms of your health behavior is going to have a larger impact on that human capital than almost anything else. Genetic disposition is going to definitely play into this because you may be prone to certain illnesses because of the genes you've inherited from your family. Here is a risk matrix, and what this is, it really kind of look at what you do in response to certain risk. Well, if the risk is low and the frequency of it happening is low, uh, if the risk is low, the severity of the risk is low, and even if it happens more often, you can accept that risk. Um, Basically, for example, getting caught in a rainstorm without an umbrella, that may happen frequently, but the risk to your health in that situation is relatively low. What if the risk is medium, the frequency of it happening is medium, and the severity of the risk is medium? Well, you may want to manage with that. So, for example, if you're riding a bike, you'll want to wear a helmet to help protect yourself in the event that you have an accident. Um, and then if you are in a situation where you have high risk, but the frequency of it occurring is relatively low, for example, if you are worried about maybe being diagnosed with certain illness, buying health insurance is a good response to this because the frequency of this happening is relatively low in comparison to other events. For example, if you have a high frequency of an event happening or a probability of a risk event occurring, for example, when you're texting, when you drive, if you text when you drive, the risk of something happening is very high and the severity of that outcome is also very high. So if you have something in this high risk, high severity, you don't want to do it. You want to avoid the activity. If it's a medium level of severity and a medium level of risk, then you can manage that by using protective equipment. And if the risk is relatively low and the severity of that outcome is low, for example, losing luggage on a flight, that's a relatively low risk and severity of that risk is relatively low, you can just accept that. You don't really have to take any action to shift the risk onto somebody else. An insurance company really is the primary way that people transfer risk to another party, like the insurance company. So to take on your risk, an insurance company will charge you a premium, and that's the cost of the insurance. It's a contract. You'll also have a deductible in that contract, and that basically is the amount that you must pay toward a claim before the insurance company comes into play on that claim. And finally, a co-payment is really a cost-sharing amount with the company. So, for example, a copay is if you have a prescription coverage with your healthcare plan, and the copay on all prescription drugs is $20. That means you are agreeing that your part of that cost is $20 on each prescription. Um, Insurance companies basically are going to specialize in different kinds of insurances: health insurance, home insurance, auto, or life. And by the way, I worked for Blue Cross. Like I said, Blue Cross is an insurance company that was primarily focused on health insurance, although they did sell life insurance. But basically, what they're going to do is they're going to look at minimizing their risks to provide the protection when the frequency and the severity of the loss is relatively low. So we're really wanting to minimize the risk of exposure to a major loss for the company. Um, and the basic way of minimizing that risk is through premiums from people. So, Blue Cross, they had healthcare groups. So, usually groups were identified by the employer, and the employer would pool um, the premiums together, pay Blue Cross. And the idea is that in that pool, a risk was spread out fairly wide because you didn't have any one group or one person, or you didn't have a large group that was high risk altogether. You had some high risk, but you also had low risk members of that group. If the severity and the frequency of the risk increases, the premiums are going to have to change. And that happens often. That's why with health insurance, you have, we used to have what you would call a trough after a 3-year cycle where you would have a peak and then a trough. And basically, on the signing of a new agreement, um, you would have a peak where your income was higher than the expenses you're paying out in claims. But then after a period of time, the claims costs would catch up with the premiums, and then you'd wind up needing to adjust that rate. When we talk about pooling costs, we're talking about putting people together who have different levels of risk in a pool so that no one group is going to be at a higher risk, so that you average out. It's a little bit like diversification in a portfolio. You have some high risk, low risk, and you have some that are in between. So if you are an insurance company, the idea is you get some young and middle age, and then you have some older people in this pool so that not all of your risk is in one group or one demographic. Health insurance is one of the biggest costs that we deal with in insurance, but it is a financial tool that allows an individual to deal with potentially excessive healthcare costs, or what we would call catastrophic healthcare incidents. Uh, Healthcare expenses are really very significant in their cost. If you were to self-insure and go to the hospital and you were to pay for surgery or something like that, it would be potentially, at least, devastating to your resources and your assets. Uh, so, one of the biggest costs in healthcare is going to be for these events that we have. The average healthcare cost for those folks who are in their 20s, for example, these are some costs that they might engage in. If you were to look at a hospital stay, you see this average cost is right around $10,000. That's an average hospital stay. That's not anything unusual, or it's not intensive care or anything like that. But this is going to be very pricey. You notice that when you get to an ER visit, it may come out around 2,000 or a little higher. A doctor's office visit depends on what kind of doctor you're seeing, but you're talking about maybe a couple of $100 at least to go to the doctor. And then prescription drug costs can be relatively small depending on the drug that your doctor prescribes. However, this can also be very high if you get into some very um, unique, or what I would say um, very specific kind of drugs that are crafted for a specific illness. Now, one example of this, and I'm only familiar with it because I've had some experience in my family, but if you are prescribed a biological medication, generally those prescription costs are very high. And if you didn't have insurance, they would be cost prohibitive. So, for example, with a prescription for a biological medication, you can see a cost of about $2,000 or $3,000 a month. If you didn't have health care, that would be unobtainable for you. So the cost to purchase health insurance is the premium that you're going to pay, and then a deductible is the amount that you have to pay before the health care company or the health insurance company will pay for any funds. The co-insurance is the sharing of costs between the health insurance and the individual. Now, co-insurance is different from co-payment. Co-payments are there always. There is a particular limit on what you're going to pay with any health insurance, and that will apply to co-insurance and deductibles, so that once you reach that maximum, then the insurance company will pay for those claims. However, co-payments don't go away. It's a flat fee, and you have to pay that to receive any kind of health care service. So if you had a $20 copay for prescriptions, you're going to pay it every time. If you had a $30 payment to the doctor, you're going to pay it every time. This out-of-pocket maximum is basically designed to prevent a catastrophic loss for an individual. If your out-of-pocket maximum is a cap that once you get to that level, you don't have to pay any more cost out of your own pocket. Now, these are usually fairly high caps, but it is possible if you had a high deductible insurance plan and a catastrophic health event, that it would be possible to reach that out-of-pocket maximum. By the way, once you hit that out-of-pocket maximum, the insurance company is paying all of it, not you. So there are other kinds of health insurance, that are different kinds of health insurance policies you can buy. A fee for service is really like a preferred provider organization. Basically, what it does is it says as long as you go to a doctor or hospital within this network, within this preferred provider network, that you will have favorable coverage from your insurance company. Uh, it's flexible in that you can go to any provider within the PPO, but it's also a little more costly because you have some flexibility in it. You can also see doctors without necessarily getting prior approval. And then once you're in the PPO organization, if you're going to a doctor in the PPO, often what the insurance company will say is, we're going to reduce your deductibles, copayment, and coinsurance if you visit one of these preferred providers. A health managed care health insurance is really an HMO. We used to have an HMO when I first started working at Blue Cross, and the HMO is great from a patient perspective because virtually all of your healthcare costs are covered. Um, and what the insurance company is doing is, by signing you up in its health maintenance organization, uh, you go to a specific doctor in a specific place to get your coverage. There can also be more other doctors associated with this, but generally the health maintenance organization has a very specific list of doctors that you can see, and anybody outside the HMO you cannot see. This is usually in a geographic area. So when I was in the HMO at Blue Cross, we were in the Chicagoland area, and our doctors were all located somewhere within that area. And we had to go to a doctor in that area in order to be a part of that HMO. These charges that we paid were relatively low and essentially very, very small compared to what you might have paid in another kind of plan. One of the things that these health management organizations are known for is basically coordinating care between providers in a way to help manage your total health care. So what happens is the insurance company through the HMO pays to this HMO, this organization who's agreed to cover all of your health care. They pay a per person amount every month to them, what they used to call a capitation amount, which basically means a per person or per individual amount for that particular HMO. So if they enrolled 100 people, they got 100 times whatever the capitation rate was. And so basically, they're paid a monthly fee whether you see the doctor or not. And that HMO then is encouraged to offer preventative care and managed care in a way that will address your total healthcare needs. Now, there are other kinds of plans that are sort of a hybrid between the HMO and the PPO. And these are called point of service. Well, one of these is called a point of service plan, and it has elements of the fee for service and managed care both. You have lower out of pockets if you use network providers, and in these kind of plans, you may have a little more freedom than you would in an HMO. So in an HMO, you have a very restricted list of doctors, often a specific group of doctors that you can go to. A point of service plan will open it up a little bit. It probably won't be as flexible as a PPO, but it will give you more choices for doctors that you can choose from. And then if you go outside of this plan or out of the network with a point of service plan, you can get approval to go out of the plan. With an HMO, you're never going to be approved to go beyond the plan. Typically, that's going to be very restrictive because they have all of these specialists and contracted hospitals, contracted physicians within the HMO. A point of service plan, though, will allow you to go outside that if you first receive an approval for that coverage, a referral, I guess you would say. And then one of the things about health insurance, we have also this plan called a consumer driven plan, which is the high deductible plan that I mentioned earlier. This is designed to reduce the premiums um, because the high deductible is so high that it's very unlikely that the insurance company is going to pay out a lot of claims. So, for example, some high deductible insurance plans have a deductible set for an annual deductible of $10,000, And it's very hard for an individual to reach that $10,000 deductible limit. But if you had an illness and you had a catastrophic illness, you'd do that very rapidly. However, with a high deductible plan, the premiums are lower. And so if you're working on a restricted budget, these high deductible healthcare plans become more attractive. Um, but you're always going to have higher expenses with this plan because you have to hit this large deductible amount. And by the way, your out of pocket limits are much higher as well. So, what they're saying here, they're showing here um, an annual minimum annual deductible 1350 in 2018 for an individual and 2700 in 2018. Now, these are the minimums that you could have. Honestly, when I've looked at these high deductible plans, a typical one will have a $10,000 deductible, maybe a family deductible, but it's still a very large deductible. Here we go. The annual out-of-pocket amount, including deductibles and co-payments, would be limited to 13,300 in 2018. So when I say $10,000 co deductible, what I mean is once you hit that 10,000, the insurance company starts to pay. You pay a part of it as well, but you're capped at the 13,300 for a family. Now, the health insurance marketplace is the one that's in response to the Affordable Care Act of 2010. These marketplace plans are in three kind of levels. You have the platinum, the bronze, and the silver and gold. Um, if you're in the marketplace, if you're in a job where they don't provide health insurance, you can go to the insurance marketplace to basically buy your own health care insurance. And the beginning point of that is the bronze level, where you have the lowest level of premiums, but the highest level of out of pocket limits. So, for example, there was a time when I was working in a job where they did not provide health care. And so I was in this health insurance marketplace and I bought into a bronze plan where we had, like I said, we had lower or more manageable monthly premiums, but we also had high out of pocket costs, which, I mentioned, like a $10,000 deductible before the insurance plan began to pay. Now, somewhere in between the bronze and platinum are these silver and gold plans where you see reduced levels of deductibles and out-of-pocket expense, but also higher levels of premiums. And basically, if you are looking at purchasing a catastrophic only healthcare plan, you're going to have a very, very high deductible but very low premiums. This would only make sense if you're younger and not at risk for some of the uh, illnesses or perhaps treatments that you may need to see a doctor more often for. A health savings account is one of those things that you can basically put some money into pre-tax. So you have the ability to say, okay, I expect my annual health care cost to be the X amount of dollars. And so you start putting money into this health savings account and you use it to pay for things like prescriptions, out of pocket medical expense, and things like that. The advantage is when you put the money in, you don't pay any tax on it. You can pay for any of these expenses. You don't pay tax on it. You can have the money in the account and growing tax deferred, uh, and you have a limit on what you can contribute into the fund each year. And then deductibles, co-pays, prescriptions, those are all you can take all those and submit those bills to the HSA. They will refund that money to you. So, basically you're paying your premiums pre-tax. You don't have to pay tax on that money. The only way you can get this is if you have a high deductible healthcare plan. So an HSA is attached to only high deductible healthcare plans. Now, there's another kind of an account. It's called a flexible spending account that allows you to do the same thing. You put some pre-tax money in an account each year. But here's the problem. You have, with a flexible spending account, you must use the money within the year. If you don't use it, you lose it. So if you put an X amount of dollars in here, it all goes in pre-tax. You don't pay any tax on it. But if you don't utilize it through the year, you lose it. Uh, so you have the same kind of allowed expenses for this flexible spending account, which includes all medical costs, dental costs for you, your dependents, and spouse. It'll allow you to do deductibles and co-payments, but not insurance premiums. You can't cover that with this. You can also use prescription medication uh, costs. You can submit those. I've had flexible spending accounts in the past, and those do come in handy. You are able to save some money because you don't pay tax on it, and then you can submit whatever expenses you have and get reimbursed for it. This flexible spending account is a way for an individual to avoid the tax on healthcare expenses, uh, which you would not be able to itemize in a tax return because of the floor, 10% floor. Now, prescription eyeglasses are also covered here in contacts. You can get insulin reimbursed and medical equipment. So, like if you had a broken leg or something and you needed crutches, you'd be able to use that money for that purpose. Okay, this is kind of an end of the topic discussion of health insurance, and it gives this example. Domingo has a health insurance policy with the following provisions: a $500 deductible, $50 copay, and 80/20 coinsurance. If Domingo has an accident that costs $3,000, how much will he have to pay out of pocket? And the answer is going to be $1,040 because he's going to pay the 500 deductible, um, and then there will be 20% of the balance, right? Anyway, that's the answer, 1040. So the third and final topic we're going to cover here today is life insurance. Do you really need it? Well, life insurance is a way to cover lost income. If you are if you have insurance on yourself or a loved one and they pass away, that insurance pays out to whoever the beneficiary is. And by the way, life insurance payout is tax free. It's a lump sum amount, and usually this is enough to cover final expenses, burial costs, any obligations that the individual may have, or other expenses. The policy owner is the one who's making the premium payments. So that typically is the insured. You know, if you're getting a life insurance policy, you're typically going to make your own premium payments. The insured is the one whose death will trigger the policy payoff, and the beneficiary is the one who's been designated by the insured to receive the payout or the lump sum amount after they pass. Term life insurance is really one of the most efficient ways to acquire a significant amount of insurance at a low cost. Term insurance means that it covers you for a specific period of time. It's a death benefit, uh, and it basically says, okay, if you die within the term, then there's a specific amount of insurance that will be paid out for that. The death benefit is the face value of the policy. So whatever dollar amount you decided to be insured for with term insurance, it's the amount that will pay out. Term insurance is also limited in terms of you don't get to have a cash value build in the policy. It is strictly all you're paying for is that death benefit. Um, the only way you get anything out of this policy is if the insured dies in that term of the policy. Typically, term insurance has a term of about 10 years, and every 10 years the rates change or the policy levels change. Uh, this is also the most inexpensive way to get life insurance. When you get older, of course, the term insurance policy premiums increase, and sometimes the value or the face value of the insurance decreases. A cash value life insurance policy is also called whole life. And really, what this means is you purchase a contract with the insurance company, and the cash value grows over time as you make the premium payments. You don't pay any taxes on the growth of the policy. You may have a policy where you can borrow on the cash value. Often, though, the cash value is a portion of the face value of the policy, so um, it depends on what your borrowing needs are, whether or not you really would want to borrow on a life insurance policy. Whole life or cash value life is more expensive than a term policy because a part of it is dedicated to this growth of the cash fund. And then if you cancel the policy before death, you may lose a substantial amount of money or pay a substantial penalty on any cash that you took from the account before you actually came to the end of the contract. So cash value policy options, what I was referring to earlier as whole life, is one of the older approaches to cash value policy where you earn a guaranteed rate of return over a period of time. Universal life insurance pays a higher rate of return um, on the cash value portion of the policy, and it has some other features that are available here. Now, in whole life insurance, you pay for the term of the agreement for the contract over a certain period of years. For example, they used to have one they called 20 pay life. You pay on it for 20 years and you have a fixed amount of life insurance for the rest of your life. Universal life insurance is similar to that in some ways. You pay on the policy for an extended period of time, uh, but it also grows at a higher rate, and you may be able to use the cash value to pay your own premiums over a length of time. Variable insurance allows you to invest in mutual funds with your savings, although this would be considered quite risky um, because mutual funds are not necessarily guaranteed. So the variable life insurance would allow you to invest in that, but there would be a higher degree of risk. And then variable universal life insurance combines the best of both universal and variable life insurance policies. Now, what do you need? Well, you need just enough insurance to meet your needs. So here, there are several ways that you can calculate what you need in insurance. You can calculate the present values of all your cash flows and current debts, bills, and liabilities. But there's also this idea of an income multiplier estimation, and this is the one that I've heard more frequently, is that you take the current income and multiply it by 10 and then decrease it by the amount of any insurance. So if you have an annual income, multiply it by 10, and that would be the level of insurance you would need. And then you'd subtract out any insurance policies you may have already. Another approach is human life value, which is a time value of money calculation based on an individual's earnings. So if you use the income multiplier estimate, how much life insurance would you need if your current income was 45,000? Well, if you just use the multiplier we talked about a moment ago, that it would be 10 times 45,000 or 450,000. Okay, so those are the three big areas. I'm not going to go into automobile insurance here. We're going to wrap this up at this end of the topic. Um, but be aware there is an assignment for Chapter 9 homework. There will also be a Chapter 9 attendance quiz. So I'm going to end this lecture video here. Wish you well, take care, and stay healthy.